Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be talking about a quick trade idea that I'm currently monitoring at the moment. It is to do with the S&P 500, which has been moving higher, as you can see in the last couple of days. We actually just about eclipsed 4,160 today, which is its highest level since the end of August. We got above the September high, and we've pushed above the December high as well. The main catalyst, of course, yesterday we had the Fed meeting, and also the US data this week has generally been tilting on the weak side. But we had the 25 basis point rate hike as expected, but Powell's tone on the outlook for inflation, the outlook for further rate hikes, I mean, it was kind of mixed, but he basically acknowledged that deflation has kicked in. And though he said that more rate hikes would be appropriate, and markets are only actually expecting one more rate hike, and now markets are pricing in rate cuts for the end of the year, markets basically ignored his message on the outlook for a couple more rate hikes, and focused more on his economic commentary or his commentary on inflation. They seem to not be believing Powell. They seem to be thinking that the Fed is not going to be able to do as many as hikes, or is not going to ultimately want to do as many hikes as what they've been saying. So more dovish than expected, which is underpinning, well, a lot of risk assets. Stocks have been moving higher. Crypto's been moving higher as well. As you can see, well, I mean, Bitcoin's actually pulling back a little bit, but it did manage to get above 24K for a bit today. You got the dollar index, which, that's the wrong asset. You got the dollar index, which actually rebounding a little bit. You're actually seeing a bit of selling pressure in the euro and sterling after their central banks hiked interest rates by 50 basis points each. Maybe a bit of a sell the fact reaction for the euro and sterling, which is benefiting the dollar right now. But you can see it had this big drop yesterday on the dovish Fed. Yields also fell yesterday. Yeah, like we had a 9 basis point drop in the 2 year. We had a 10 basis point drop in the 5 year. 9 basis point drop in the 10 year. So yeah, dovish market reaction supporting stocks and other risk assets. And the case, oh, and by the way, Facebook earnings were pretty good as well, actually. We just had that out. Upcoming, we've got Alphabet, Amazon, and Apple. Yeah, I mean, three of the biggest. So if they're good like Facebook, then that could certainly underpin a little bit more upside. And I'm thinking the the bearish case is weakening a lot on multiple fronts. On the fundamental front, all the things we're just talking about with the Fed being more dovish than expected. Like, remember, a lot of people thought that Powell was going to be hawkish and try and push back against recent easing in financial conditions. People were thinking that was going to weigh on stocks. But wasn't the case. US economic fundamentals point towards a more dovish Fed later this year, which in the short term future could continue to support stocks. Obviously, when a recession does come, if it's deeper than expected, that might cause a bigger than expected recession in US corporate earnings, which could ultimately weigh on stocks. But for now, the focus seems to be more on the Fed rather than the economy. Which could continue to support stocks in the short term future. But the technicals are also looking very, very nice. We've had now a definitive break above the downtrend of 2022. The 200-day moving average, I haven't got on the chart, but it's also down here. Like, we had this time where we failed to get above this. Well, we failed multiple times in December and then in early January to get above the downwards trend line and the 200-day moving average. But we managed that break around. I mean, I think this was an important moment when we had this little pullback on the 25th of January, and then the bulls bought the dip, and then they bought the dip again on the 31st. And we've just been pushing higher ever since. The RSI is still not in overbought territory, meaning we could potentially continue to crawl higher, maybe hit 4,200 before you really start getting some profit taking. But ultimately, I think if the earnings are decent, if people continue to be optimistic about the Fed not being quite so hawkish this year, I think we can hit this high from August in the 4,300s in the near term. And my trade idea pretty much is you want to be looking to buy dips. So, dips back towards or back below 4,100. You got this support area here, could be nice. Perhaps you get something a little bit deeper, and you start having another look at the 21-day moving average or the 50-day moving average. These areas down here. I mean, I wouldn't bank on us going that far back unless there's something like really hot economic data. Speaking of which, the main event now, beyond just earnings, US jobs data, official jobs report on Friday. If that comes in softer than expected, I mean, we're already expecting a softening in the labour market from this data, then that's certainly going to support stocks because it's going to support the case for a less hawkish Fed. But then equally, if this comes in very, very hot, could trigger concerns that maybe the Fed won't do this dovish pivot. And it's the same story for ISM Services PMI. Pretty much the way we're looking at data right now is bad, is good news for the stock market. So, 50.5, that's a slight recovery. If we see that come in below 50, then that could potentially support sentiment as well, I'm thinking. But yeah, guys, that's pretty much what I'm watching with the S&P 500 right now. Hope you all enjoyed the video, and I will see you all in the next one.